Nobody likes paying taxes. In this video, we will show you how to pay less. Hello, my name is Taylor Mark with Grace Financial Solutions. Thank you for joining me today as we dig deeper into a subject that none of us want to talk about, but it affects all of us. Ignorance is not bliss when it comes to managing our finances. So come on, let's jump right in and look at this. But before we do so, don't forget, like my video, subscribe, and oh, for sure, share it. Benjamin Franklin said, "In this world, nothing is certain except for death and taxes." In previous videos, we talked about being financially prepared in the event of death. Today, we're going to get into some tax basics. In Canada, we have a graduated income tax system. That means that the more money you earn, the more taxes you pay. Income taxes has two parts. You have the federal tax, which is the same for everyone, and the provincial tax that will be depending on where you live. The marginal tax rate gives you the different rates that you would be paying based on your income at the different levels and different brackets. At the lowest income level, you pay $0 in taxes because your income is below the personal amount. Think of a high school student working part-time job and making less than $11,000 per year. For 2018, if you live in British Columbia, the combined marginal tax rate for federal and provincial rate is just above 20%. So that means for every dollar that you earn above the personal amount, you have to pay 20 cents to Canada Revenue Agency in tax. And that tax rate is applied until your income climbs up to the next income bracket. And the next tax rate is then applied to that amount. The highest combined provincial and federal tax rate in British Columbia presently is 49.8%, which kicks in when your income goes over $200,000 per year. However, there are a few different methods that we can use to offset the taxes we pay as our income grows. I am consulting with Jan Mark, a reputable CPA with Mark & Tsang accounting firm, to get her to help us with some tax preparation tips. What are some common tax preparation mistakes that you see?
The common mistake that I see, the top one, is foreign asset reporting. Most people are just confused about what it is and when to report it. Basically, if your foreign asset is costing more than $100,000, you will have to report it. Foreign assets such as assets that you own outside of Canada, for example, a US bank account or a vacation property outside of Canada, or just an international portfolio that's inside the non-registered RSP account, you will have to report those.
What is the difference between a tax deduction and a tax credit?
A tax deduction is a reduction against taxable income. The amount of savings that you get from it will depend on your personal tax marginal rate. So for example, a $1,000 deduction with a 30% margin, you will get $300 in tax savings. A tax credit, on the other hand, is a dollar-for-dollar reduction against the tax liability that you owe. For example, if you get a $1,000 tax credit, you will get the $1,000 directly against the tax that you owe.
Is there a superhero among tax credits?
Superhero? Yes, giving in Canada does give you a pretty good tax credit. So for the donation that you give out to help organizations such as charity, the first $200, the credit you get will be the lowest marginal rate, and anything after that will be at the highest marginal rate. And for 2018, that would be almost close to 50%. So for example, if you pay $1,000 to donation, the amount that you will get back will be around $400.
What is the typical tax deduction available for employees?
For employees, the tax deduction is quite limited. So the most typical common one will be the RSP deduction, the Registered Retirement Savings Program.
Due to restriction in having an RRSP, what would be an optimal income level that one should start at?
That would depend. It depends on the personal individual's tax situation, and it depends on the retirement tax rate at the retirement age, and also whether you are able to have the discipline to save or not. RSP is a program that is the government have in place for you to defer your current income and pay tax into the future. So in my opinion, anytime you have the opportunity to defer tax, I would do it. That's a discipline to save for your retirement.
How else can we take advantage of tax deductions?
Well, as an employee, the deduction is quite limited, as I mentioned before. But if you're self-employed, there are a lot more deductions available to offset against the business income. For example, the rent that you pay to operate your business, the home office portion that you use for your business, the wages that you pay to your employee, and all the office supplies, and your vehicle use, the dinner meal that you took your client out, all those are deductible against your business income.
Thank you, Jan, for providing insights on how to prepare our taxes effectively. We look forward to hearing more from you in our future videos. It is a good idea to consult with a CPA on how to take advantage of our tax deductions and tax credits. Don't be discouraged by our tax system. In future videos, we will continue to expand on how we can manage our taxes and minimize what you need to pay so that you get to keep more of what you make. I need your encouragement to continue with our Street Smart video series. Please like and share this video and subscribe to our channel. We want to continue bringing more topics to you month after month. This is Grace Financial Solutions, financial success made simple.